Welcome to our video about the differences between forwards and futures. You can think of these as two different ways to agree on a deal today for something that will happen later. While they might seem similar at first, they work in very different ways. One is like a private handshake between two people, while the other is like a busy public market where everyone follows the same rules. In this session, we are going to explore why these differences matter to you as an investor. Let's start with how these deals actually take place, which we call the operational mechanism. Imagine you and a friend agree to trade a bicycle next month for a set price. That is a private deal that does not happen on a public platform. This is exactly how a forward contract works. It is not traded on any exchange. Now, imagine you go to a huge, busy stock market where thousands of people are trading. This is the world of futures, which are exchange traded contracts. The big difference here is whether the deal is a private agreement or a public one managed by an organized marketplace. Because forwards are private, they can be designed exactly how you want them. These are what we call tailor-made or customized contracts. You and the other person can decide on the exact date, the exact amount, and the specific quality of what is being traded. It is like a puzzle piece that is shaped to fit your specific needs perfectly. Futures, on the other hand, are standardized. This means the exchange has already fixed every single detail of the contract, such as the amount and the date. The only thing left for you to decide is the price. Think of it like buying a shirt off the rack in a specific size rather than having one custom sewn for you. Now, what happens if the person you're dealing with decides not to follow through? This is the idea of counterparty risk. In a private forward contract, this risk is quite high because you are relying entirely on the other person's word. While sometimes a guarantor might help, the danger of the other person failing to deliver is always there. Futures solve this problem by using a clearing agency. This agency acts as a middleman that becomes the buyer to every seller and the seller to every buyer. They provide a guarantee that the trade will be settled, which makes the risk of someone backing out much lower. This leads us to the liquidity profile, or how easy it is to get in and out of a trade. Because forward contracts are so specific and customized to two people, they are very hard to sell to someone else. It is like trying to sell a very specific handmade tool that only one person knows how to use. This means liquidity is low. Futures are the opposite. Because they are standardized and traded on an exchange, there are always many buyers and sellers ready to trade the exact same thing. This high liquidity makes it easy to jump into a trade or leave one whenever you choose. Another important area is price discovery, which is just a fancy way of saying how we find out what something is worth. In the forward market, things are scattered and private, so it is hard to know if you are getting the best price. It is not very efficient. Futures markets are much more efficient because they use a centralized trading platform. All buyers and sellers come together in one common order book. It is like being in a room where everyone is shouting their prices at once. It becomes very clear very quickly what the fair market price actually is. Finally, we have to consider the quality of information and how fast it travels. In the world of forwards, information can be poor and very slow to reach everyone because the deals are private. In contrast, futures are traded nationwide. Every bit of relevant news or data is quickly shared with everyone at the same time. You can think of forwards like a letter sent in the mail, while futures are like a breaking news alert that hits everyone's phone at once. By understanding these key differences, you can better navigate which type of contract fits your financial goals.